Right. Good evening, ladies and gentlemen, and I highly believe that you were successful in your assessment yesterday. Right, those who were writing. Right. Let's proceed today. Also, today, I want to proceed further and look at capital allowances that can be deductible for business purposes. Remember, when we were looking at the general deduction formula, we said that an amount will not be deductible if it is of a capital nature. For example, if you buy machinery that you want to use in your production process, the cost of that machinery, you cannot claim it as a deduction in the year that you purchase the asset. However, those capital assets can qualify for a deduction in future in the form of what we call wear and tear, which is what we call depreciation in accounting. So although it's of a capital nature, you can't claim the whole amount when you acquire the asset, but you can claim subsequently using formulas that are allowed by SARS, depending on the type of asset and various things that we're going to look at. So our main focus for today and our class most probably next week will be on the capital allowances that are deductible for I would start with the mainly with for businesses, right? So now right, capital allowances, right? So we can just say that this deals with deductions related to assets, to capital assets, which are not deductible on acquisition, as they are of a capital nature. Right. However, deductions are allowed in terms of wear and tear, also called capital allowances, or tax allowances. So all these terms, we can use them interchangeably when we're looking at these allowances that are related to capital assets. Right. First of all, we can look at repairs and improvements. Right. There's been confusion when it regards to repairs and improvements. Repairs are deductible in terms of the general deduction formula. In the year that they are incurred. Whereas improvements are added to the cost of the asset. And will subsequently be deductible through wear and tear. So it is important that if when you do adjustments on your assets, you exactly know what is a repair and what is an improvement. Because if it's a repair, you can be entitled to claim a deduction during the year that you undertake the repairs on your capital assets. Let's say your building, your roof was leaking, you repair it. The repair cost can be deductible for tax purposes. Your motor vehicle had a problem and you went to the mechanic, he sorted it, that can be deductible. But they are what you call improvements. Improvements now, like according to, there's no definition in the act per se that gives that distinction. But we have got court cases that have assisted in helping us understand the distinction between repairs and improvements. Right. So the court cases that dealt with the distinctions between repairs and maintenance. We have two prominent cases that have dealt with this part. We have the Fleming versus commissaries. These cases, you might need them one time. I think, like even those who were writing, I think you saw that there are sometimes that they will ask you to also quote these cases. But in some instances, they might not need them. So you have to be very careful. If they say they don't need them, don't include them. But if they say they include them, they need them, then you have to include them. So this is one of the cases that have dealt with this part. Then we also have commissioner for inland revenue. Versus African products. Manufacturing Company Limited. So these cases had disputes between the commissioner and the taxpayers on whether the repairs that were there were improvements or repairs. Like in one of the cases, there was an issue of a bore which was no longer generating enough water. Then they had to do adjustments to make sure that it can get more water. But then it was discovered that the problem was not because of the borehole. The problem was because there was no water on the ground. So it was taken as an improvement, not necessarily a what? A repair. Right. So there are various principles which assist in drawing the line between repairs and improvements. So someone can ask, why is it this distinction? What I'm talking about that. Why is it important? It is important because claim a deduction in that year that you incurred them, whereas improvements will be capitalized and will only be systematically deducted as part of the capital allowances. Right. Repair is regarded as restoration by renewal or replacement.
This is for this.
So you are trying to bring your asset back to its previous capability. Of subsidiary parts. Of it all. Then a renewal is reconstruction of the entity. So they distinguish between renewal or replacement when they are talking about an asset, whereby they say you can either replace a part. Let's say there are some gears that are not working on a motor vehicle, then you can be able to replace them. That can be a repair. Right. Right. Then another case, in the case of repairs constituting renewal, it is not necessary that the materials used are identical to the materials replaced. So it doesn't necessarily mean that when we are saying you're repairing, you exactly used exactly the same material. You can use a different material, but the idea is to just restore the asset to its state that it was in prior to the problem that arose. Whereas an improvement, you are making it better than what it was even before the repair. Right. Right. Improvements increase income earning capacity. That means before the problem, your income earning capacity was lesser than after the improvement has been done. So the result of an improvement is that the capability of the asset is even far better than what it was before the problem arose. Whereas a repair simply restores it to its earning capacity, which it had prior to the problem happening. You are simply making it work like what it was doing. But whereas an improvement, you make it even better than what it was. So let's say your machine was producing 20,000 units per day. Then it has a problem. It was damaged during load shedding. Then you sort it out so that it can produce those 20,000 or slightly lesser. That is a repair. But then when you are trying to sort it out, then you learn about new technology that can even make it more capable. Then you put that new technology, then the asset starts producing 30,000 units. That is not a repair. That is an improvement to the asset. So an improvement has got the ability to increase the income earning capacity more, to be more than what it was before the problem arose. Right. Repair restores the assets to the original condition. That is to the state that it was before the problem arose, before we started to do the repairs. So it's simply we're trying to get it back to its form that it had before the what? The problem arose. Right. Improvements leads to an improved or better asset. So that means the asset that arises at the end is better than the one that was there before we started effecting the improvements. So it results in a better asset. Right. Right. Repair of inherent faults. does not constitute repairs. Right. Let's say you buy a car, but when you bought it, it had some problems. Then you start sorting those problems. That's not a repair. Actually, that's part of the cost of the asset. Or maybe you were constructing a building, then later when the building is handed over, you learn that there are defects. That's not a repair. It's additional cost of the asset. So such costs, if you are trying to, which are like which you sort, which are in the asset before you even like on the time at the time that you buy it, and you now try to fix it to be proper, those are not repairs. So the moment you buy a car, and when you buy it, maybe it's a second-hand car with its own problems, then before use you have to do some fixing that you have to do. That fixing will be not be considered as a repair that you can claim as a deduction in the year of repairs. It will be considered as part of the cost of the asset. All right. So you should be able to know. So then at the end of the day, after determining whether it's a repair or an improvement, we should know that repairs would then be expensed or deductible during the year that you incur them. Whereas improvements will be added to the cost of the asset. Right. Now I will look for capital assets or assets used in the process of manufacture and other special allowances. Right. There are special allowances that are granted by SARS when it comes to assets that are used in an approved process of manufacture. So if it's an approved process of manufacture that SARS approves, then it can be regarded as a process of manufacture. Right. There are special capital allowances granted on assets used in the process of manufacture. Approved as such by SARS. So there is no actual definition of a process of manufacture. Right. But we've got some guidelines that we have, like, for example, the end product should be different from the input. Then there should be a large number of standardized products that should be produced for us to call it a process of manufacture. Right. SARS issued practice note 42. Listing processes accepted as processes of manufacturing. Right. So if you have a an approved cost of manufacturing, then there will be special rates, which we're going to talk about very soon. Right. Cost of assets. Just like in accounting, when we're regarding the cost of an asset, we take into account its original cost price, plus any other direct costs that you have to incur for it to be usable. For example, transport that you're going to incur, installation fees that you're going to incur, they will be included in the cost of the asset. Non-refundable taxes like customs duty. If you pay any of VAT, if you are not a VAT vendor, you would also include it in the cost of the asset. But if you are a VAT vendor, you won't include VAT. All right. So the cost of an asset, this includes purchase price. That is the price at which you bought the asset. VAT, if not claimed. There are various circumstances in which you cannot claim VAT. For example, if you are not a VAT vendor, you cannot claim VAT. So as long as you didn't claim it, the VAT will be included in your cost of the asset. Then we can also have maybe if you're a VAT vendor, but you bought a motor car. If you buy a motor car, then VAT will be denied. So your cost should can include VAT. Right. Customs and excess duty. If there's duty that you pay towards the asset, that will also be included in the cost of the asset. Improvements. For the improvements, remember what we were saying, that there's a distinction between repairs and improvements. So if you improve your asset, they will be added to the cost of that asset. Installation and erection cost. So any cost of installing your plant and machinery, or making sure that they are in their position, they are also included in the cost of the asset. Cost of foundations. And structures. Maybe you are constructing a building, the foundations and all the structures that you are going to make there will be included in the cost of the assets. So all direct costs, so you would find that this part will not be a problem very much, because it is usually the normal way that we normally deal with assets. Right. The cost excludes the following. VAT that was claimed. So if you claimed input VAT when you acquired the asset, you cannot include that VAT in the cost of your asset. Finance charges. Like in accounting, I think we know that sometimes we include borrowing costs that you incur to borrow funds that you are going to use to buy the asset. So SARS will not. Training costs are an expense. If you are training your employees to use an asset, they will not be part of the cost of the asset, Julian. So if you have got any cost of training the employees, they will be regarded as a normal, not the cost of an asset. Is that right? So there are slight differences that are there between accounting and tax. For example, what we just talked about here, the finance charges, you'd find that there are certain circumstances whereby finance charges can be included. Is that right? And there will be some instances whereby we will be using the lower of cost and market value. Right. Then you also do not include foreign travel expenses incurred in order to buy the asset. So they will not be included.
Eugene,
Yes.
why don't they include the foreign travel expenses that incurred to buy the asset, but they include delivery?
No, it's like a delivery will be included. Is that right?
Yeah.
When we talk about foreign travel expenses, maybe we mean maybe officials going there to the foreign land to acquire the asset. Then you give them maybe travel allowances and stuff like that. Those will not be included in the cost of the asset. But the
Yes.
transport will be
My
the
question is why?
transport and shipping will be included.
Oh, all right.
The transporting of the actual asset itself is not what we're talking about here. Okay, I think Roshan is also giving us an idea there that maybe we have not yet acquired an asset. Right. Another thing, when you acquire an asset and the cost of the asset, the cost of the asset includes amounts that cannot yet be quantified. Maybe it can be for various reasons. Maybe there was an exchange of assets for which we cannot immediately determine the value. In the cost of asset, we can only include amounts that can be quantified. Is that right? Then I think in the last topic, we also dealt with leasehold improvements, whereby we said that if there are any leasehold improvements, you can be allowed to deduct them as long as up to the amount that you agreed in the contract. I think though I'm just reminding you the things that we have already covered, which can also affect capital assets. All right. All right, capital allowances. In respect to small business corporations. We call them the section 12E. Right, a business can be registered as a what we call a small business corporations. There are requirements that you should meet for you to qualify as a small business corporation. Now, if you qualify as a small business corporation, then there are special allowances that you can be granted, which are not available to some other companies. So they've got a special allowances, right? That they are granted. These allowances are normally divided into two categories. Right. One, manufacturing, plant and machinery. Right. A small business corporation I'll call it SBC, can claim 100% as a deduction in the year of purchase for new or used plant and machinery. Brought into use after 1 April 2001. Right. So what are we saying? If you are, we are emphasizing the new or unused because you are going to find that for another entity, your allowance that you can claim will depend on whether you the asset was new or it was used. Right? As long as you bring into use plant and machinery which are used in the process of manufacture, then you can claim the 100%. Is that right? So as long as the plant and machinery is used in the process of manufacture. And please, let's know that this one is a general rule. Capital allowances, maybe let me just write it up there because it applies to all capital allowances that we are going to look at. Capital allowances are granted from the day that the asset was brought into use. Remember that in accounting, we provide for depreciation from the day that the asset is available for use, not necessarily when it is brought. So in accounting, if you construct your factory and you finish it by 31 December 2023, and you are happy that it's now fine by 31 December 2023, from 1 January 2024, we start providing for depreciation. But SARS will not grant you the tax allowances until the asset has been brought into use. That means from the date that you start using the asset, that's when you qualify for the capital allowances. Right. So if the asset is being used for a process of manufacture, then you can be able to claim 100% in the year that the asset is acquired. Other assets. Right. All other assets not used in the process of manufacture the taxpayer can elect right claim a deduction in terms of Section 11 E. We'll look at it. Or right, when we talk about section 11E, we're saying you can elect to just be get the deduction just like other businesses. Is that right? That are not small business corporations. Or you can have a special allowance, deduct 50% of the cost in the year of purchase. %30 in the second year. And then 20% in the third year. So other assets can be deducted in a 3-year period. Is that right? So it will be a 3-year deduction. We normally call it the 50, 30, 20 rule.
Mr. K,
Yes, my boss.
talk to me. What if the question is not what if the question is not specific in terms of the other type of asset, the other asset?
They'll always specify.
Oh, okay.
They'll always specify it for you.
All right.
Right.
I would like us to deal with the lease, but I'm not prescribing what you must do.
I can't hear you.
I would like us to deal specifically with lease because it's one of the questions that is so much. It comes a lot in this type of questions.
The what?
Lease.
The lease I dealt with it. I also dealt with it, but also I will look at it again. But I dealt with it.
Yeah, please.
But I also dealt with it sometimes. We said other assets. Any other assets that are not for the process of manufacture. For example, you can have your office machinery, your motor vehicles. As long as that asset is not for the process of manufacture, and right, the section 12E, you should know that it does not apply. It does not apply to buildings. So the buildings will be will get allowance just like any other business, which is not a small business corporation. So we don't apply this to buildings. So it will apply. So this section 12E will apply to any other assets. That means we take out the buildings. Then if it's plant and machinery, we'll apply number 1, 100% in the year of manufacture. Any other assets, then we'll then apply this other rule of 50, 30, 20. If it's and these allowances only if the question states that the business is a small business corporation. Right. The section of allowances are not apportioned. The deduction is deducted, is claimed in full. Even if the asset was bought or sold during the year. Let's look at an example. Eugenius Limited is a small business corporation. And its year of assessment ends on 31 March 2023. During the year 2023, the company had the following assets. Plant and machinery, but 1 August 2021. Right. Then we had the motor vehicle. But 8 September 2021. Furniture, acquired 15 July 2020. Right. During the current financial year, the following transactions took place. The above furniture bought on 15 July 2020 was sold on 1 October 2022. New furniture costing 280,000 was acquired on 1 February 2023. A new plant used in the process of manufacture was acquired on 1 July 2022. Then a second hand machinery used in the process of manufacture was acquired on 1 December 2022. Determine the capital allowances that can be claimed by Genius Limited. All right, so we need to see what are the allowances. So we want to apply section 12E. So I want you to follow me here as I try to apply section 12E so that you can be able to see how we apply section 12E. Right. Right. So my friends, we have the plant and machinery, bots. Okay, let me just copy too so that I don't waste time. This one there. Let's remember our period of assessment is our year of assessment is ending 31 March 2023. That means it started 1 April 2022 to March 2023. Right. Now, if it's a small business corporation, that means the allowances that they can be able to use section 12E. Now, because they can use section 12E, this plant and machinery, that means it was deducted. Yes.
You wrote 31 March 2923.
Okay, thank you. All right. What will happen here? This plant and machinery was bought on 1 August 2021. So this one was fully claimed in 2022 year. So that means there will be a zero deduction because they will have claimed the 100% in the year 2022. Remember, for plant and machinery, you can claim 100% of the deduction if you're a small business corporation in the year that you purchase it. So the year that they purchased was the 2022 tax year. So they will have claimed the 100% in 2022. So now, although the asset is still there, they can no longer claim anything. So there will be no claim on this. Right, then we've got the motor vehicle. This motor vehicle was bought on 8 September. Remember that our year is ending in March. 8 September 2021. Because it's not an asset used in the process of manufacture, we are going to determine our way in tier according to the a 50-30-20, 50-30-20 rule, right? So that means since they bought this asset on 8 September 2021, that means in the first year was the tax year ended 2022. Remember, our year is ending in March. So in 2022, they claimed 50%. And we are now in 2023, so we're only going to claim 30%. 30% multiplied by 300,000. Then I can just comment here that 50% was claimed in 2022 year of assessment. Please don't forget that our year of assessment is ending in March. So the first March after 8 September was 31 March 2022. And remember that this allowance is not apportioned. So although it was September to 31 March 2022, it was about 7 months or so, they will still claim the full 50% in that year. So in this year, they will only claim 30%. What will we get there? 90,000. Thank you so much. Right. Then they've got a furniture acquired 15 July. Furniture is not plant and machinery 2020. Right, because it was bought in 2020, that means 50% was claimed in 2021. Please, guys, don't be confused why I'm leaving out 2020. The 2020 year had already finished when it was acquired. Remember that the year is ending in March. Then 30% was claimed in 2022. So this year, okay, we also have another comment. Although they sold it on 1 October, we will still have a full claim for the full year. The allowance for according to section 12E is not apportioned. The allowance in terms of section 12E is not apportioned. So we're going to use 20% and there will be a claim of 70,000. So you should know that if it's any other asset other than one that is used in the process of manufacture, as long as it's in its first year, 50%. In the second year, 30%. In the third year, 20%. If it's more than 3 years, 0. So like this furniture, if it had been bought in 2019, they were not going to claim anything, because the 50 would have been claimed in 2020, the 30 in 2021, and the 20 in 2022. So in this particular case, they will claim 20%. So that also deals with this. So the fact that it was sold during the year and we only used it from April until September, it doesn't matter. This allowance, small business corporations, when they use section 12E, there is no apportionment. So when an asset is bought or sold during the year, it will just be a full year's allowance. Right. Then new furniture costing 280 was acquired on 1 February. 2023. This one, it's in its first year, so it will be 280,000 times 50%, which is 140,000. The fact that it was bought on 1 February, we don't consider that. Even if it's bought, if you bring it into use on 31 March, the last day of the year, then you can also claim a full year, as long as it was brought into use during the year of assessment. Right. Then new plant. Right. Plant, as long as it's used in the process of manufacture. I didn't put an amount here. Let me put an amount. 650,000. As long as you acquired it in the current year, you can claim the full amount. You can claim the full amount 100%. Then second-hand machine. Again, you can claim 100%. Let's say it's 320,000 here. Right.
Eugene,
Yes.
could you please repeat the new furniture, the 280,000?
It's in the first year. So the fact that it was bought, remember that other assets, they claim 50% in the first year. So it was bought on 1 February. So I was saying that the fact that it was bought on 1 February, that means we only used it for 2 months. That is not an issue with us, as long as you are claiming Section 12E allowance. Section 12E allowance is not apportioned. This does not apply to all allowances, my friends. Here, we should know that we are dealing with a small business corporation. So this non-apportionment applies to the Section 12E allowance, which is granted to small business corporations. So whatever I'm saying now, whatever allowances I'm calculating now, you only apply this if you are dealing with a small business corporation, according to Section 12E. Any questions? Right. So then the total allowance is that. Yes.
Sorry, Eugene. So we assume that furniture was used in the process of manufacture.
Which one?
The furniture, because I'm just thinking, how is furniture being used in the process of manufacturing?
No, I said I didn't say furniture. I never said furniture used in the process of manufacture. My sister, I think maybe
you said all the other assets not used in the process of manufacture. Oh, okay. So long as they bought it, it's gonna qualify for 50-30-20.
Yes, all other assets that are not used in the process of manufacture.
Oh, okay, that are not directly
those
used.
ones
Okay.
in the process of manufacture, it's 100% deduction.
Okay, okay.
Right. No, furniture is not used in the process of manufacture, Roshan. It's not a plant and machinery. The 100% is only for plant and machinery. But the furniture is it's not used in the process of manufacture. That's why it's 50-30-20. So we only claim 50%. This was bought on 1 March 2023. Our year is ending on 31 March 2023. So we used it for 2 months, but as long as it's a small business corporation claiming a Section 12E deduction, then that issue will not be applicable. Right. The last concept that I just want you to leave today. Yes, no, Sasha. Perfect, no, Sasha. So it's a 100% only for plant and machinery used in the process of manufacture. All other assets, 50-30-20, except buildings. That is for a small business corporation. Right. Assets. Right. For all other businesses that are not for all other companies that are not a small business corporation, they can also claim special allowances on plant and machinery according to Section 12C. Now this is no longer Section 12E. So they can claim a Section 12C allowance. So please let me mention that other companies. Right, the SBC obviously will take the 100%. But okay, let's assume that you are not a small business corporation. You are not a small business corporation, and you've got assets that you are using in the process of manufacture. Now, when it comes to other companies that are not SBC, there's a distinction between new and unused and second-hand plant and machinery. They've got different rates. So if you saw on an SBC, there was no difference whether it's new or second-hand. It was just 100% allowance in the year that you start using the assets. But now, when it comes when it comes to new and unused plant and machinery, the deduction is 40% in the first year, 20% in the second year, 20% in the third year, 20% fourth year. So we call it an accelerated allowance. So this is applicable to new and unused. Right. Now there are various things that have to be considered for us to. There's someone who is asking that when will we consider in SBC and stuff like that. One thing that we should know is there's a 2.5 million threshold, and also there are other things about the types of shareholders and stuff like that. Maybe I can send you that so that you can be able to see it.
What is SBC?
A small business corporation. Remember, I stated here so that when I use it later, you know what I'm talking about. I think I stated somewhere here. That is a company that qualifies as a small business corporation. So there are requirements for it to qualify. Companies can qualify to be a small business corporation subject to certain conditions. So I'm not talking about those conditions right now. So you find that in your exams, normally you don't have to think on your own whether the business is a small business corporation or not. They'll always tell you that the business is a small business corporation or the business is not a small business corporation. Right. Number 2. Then there is a different used or second-hand plant and machinery. So if you buy used or second-hand plant and machinery, 20% claim for 5 years. So you don't have the what? You will not qualify for the 40% in the first year. You will not qualify for the 40% in the first year. So you only have 20%. So I want you to see that there's a distinction in terms of this allowance, whether the asset was bought second-hand or you bought it new. There's a distinction on whether the asset was bought new or it was bought second-hand. Sorry,
Okay, you've got 205.
Right. So if it's second, the difference is that if it's new, there's 40% in the first year. So like for example, this plant and machinery, this one which was purchased new, it was going to be 40% in the first year. Then this one which was purchased the second hand, it was going to be 20%. Right. And we should know that the section 12C allowance is not apportioned. So even if you bought an asset during the year, you can get the full allowance. And you should know that the allowance is not applicable to the banking, financial, insurance, or rental sector. Right, and as we said that you can only claim a deduction if the asset has been brought into use. Any questions? All right, if we don't have any questions, we'll call you next week. So next week we'll look at the building allowances. That's when also we'll look at leases that my colleague was asking about. That's when we'll also look at other assets that is for a business, which is not an SPC or a small business corporation. Thank you so much, and God bless you richly, and have a blessed weekend.
Bye-bye, sir.
Thank you.
Thank you.
Thank you so much, guys.
Thank you.